It's February 18th, and this is, of course, the video log. It takes 30,000 to a million. After I take you through the account, we're going to look at some charts. We're going to try to figure out whether the market is overvalued. Specifically, I want to talk about Dow Jones. So, here we go. Going into the account here, I'm sitting at $152,000, about $4,000 off the high. Mainly, Apple has been slowing me down lately, so that's been the biggest drag onto the account. However, I have been able to make up some of these losses through my premium income by selling puts, etc., and calls. I'm going to list, or the positions are listed over here, starting with the options. I'm going to quickly scroll the screen down. Over here you can find the ticker, the strike price of the option, the put, whether it's a put or a call, expiration date, number of contracts, and whether it's a sell or buy. So I'm going to quickly scroll through. You can pause the video at any moment to try to figure out the exact positions. You'll find all relevant information over here. And then after I show you this, we're going to look at some charts. Okay, and you'll see that what kind of conclusions you can come up with. Now, Apple, you can see it's almost down a lead amount, 1337 on the day for me. Other equity movers are energy fuels, which took a little bit of a hit, but thankfully I have it all pre-sold with call options, and I'm getting some pure profit from URG here. Everything else was fairly flat. EBIX made a small move upwards, which I like. I needed to stay between $40 and $60 for some of my trades to work out for the next few months. If it goes above $60 though, I'm not going to hate it. You'll see here, I picked up 10 shares of Verizon, 4 shares of Alibaba. I want to talk about the Verizon pickup in a little bit. If you all been following the news, you may know what inspired me to look into it. This is the 1 week chart of the account. I'm down 2.25%, which is not super good, but a lot better than Apple. In fact, I want to compare the performance of this account against Apple's performance maybe in the last 3 months. So you'll see the account's performed is up 16.5% in the last 3 months. If I go to Apple here, so 16.5 versus a 3-month performance of Apple of 9.48. So my overall account performed a lot better than just Apple in the last 3 months, which says a lot, because Apple is like a third of the account. It's a really big component. So the rest of my account has been performing really well and making up for some of the slack here from the giant company that I like to invest in right now. So here's the account tab. I'll quickly run you through it. I'm going to sort it by total return first. You can see Apple is up at the top, followed by energy fuels, UR Energy. Man, uranium's doing well. Like, I wish I didn't get rid of all my chemical positions at like $11. I thought I'd have another chance to just keep getting back in, but it dropped down to maybe 13 and it just never looked back. So who knows? I think I missed the train. But I'm not sad, because I got so much money from chemical by selling puts and calls against it that, I mean, I can't be mad. And this is sorted by equity. You can see my biggest positions here: Apple, followed by emerging market bonds, and then EBIX, realty income, energy fuels, energy transfer, etc. So that's the account. Now we're going to look at some charts. So markets are hitting new all-time highs, and a lot of people are wondering, like, what's up with that? And many people are calling the market overvalued. They're saying, you know, it's overextended, this and that, and it's really easy to tell by the graphs. If you look at the Dow Jones Industrial Average graph, you see that it's gotten pretty high since it bottomed out after the pandemic, and same with the S&P 500. So what I decided to do is to just try to look at some stocks individually that comprise the Dow Jones Industrial Average and see what their numbers look like at a first glance, just as a quick glance, without going in depth into their specific situations and industries, but just an overall kind of Hawkeye's view as to how the company is doing and whether it looks overvalued or extremely extended, just by their books, by their numbers. So I pulled up some representative stocks from the index, and we're gonna look at them one by one, without the charts, and see if they look overvalued or not. All right, no charts. So I'm gonna start over here with 3M, and some things that jump at me here is, all their margins are great, and then the current price to earnings in ratio is almost 20. Forward is about 17, which is decent. That doesn't scream bubble. That doesn't scream overvalued for sure. You can see that they pay a really nice dividend of 3.35%, and they have a 63% payout ratio down here. You can see that, and that means they can cover their dividend no problem, and they get to play with some extra money. So I'm not a hater of this company. I don't think it looks overvalued or bubblish at all. Like I might put some money in it. I mean, there are probably better things to invest in than 3M, but I don't think it's losing or anything like that. I also looked at the, by the way, the trends of a lot of these companies, like whether they're growing in revenue or in earnings, and what the trends look like. And most of them, with the exception of maybe IBM and a few other companies that are kind of in decline, in a not cyclical, but secular decline. Most of the companies actually growing revenues and growing earnings. So it's really interesting to see that the companies are actually, overall doing well, in good health. So this is 3M. Now some financials here. Golden State. Goldman Sachs. Golden State not doing as well as it used to be, but Goldman Sachs is doing really well. PE right now is 12.65. Forward PE 9.65. I mean, this is the gold standard, no pun intended, of investment banking companies. They have a really good employee to market cap ratio, which I like to look at sometimes. It's one of my personal measurements that no one else uses, as far as I know. And so their margins look okay here, and they pay a 1.6% dividend, which is okay, and their payout ratio is really low at 37.6%. It's not a very shorted stock. I mean, nothing jumps out at me that screams overvalued here. In fact, this is a steal. I would pick this company up, in a minute. I mean, I should probably buy some Golden State, some Goldman Sachs, but I just don't have the money right now. I want to buy a lot of things. Let's take a look at JP Morgan. Similar story there, right? Margins look okay, even a higher dividend with a similar payout ratio, so they're making a ton of money here. PE 16, forward is 12.75. It looks fine. Nothing screams bubble here. In fact, it screams undervalued. It's very good. Very undervalued. Okay, how about some consumer like Coca-Cola, right? The staple. Now this is where things starting to get a little bit interesting, right? P is a bit high at 28.07, and it's mainly because of the restaurant business has been hit so hard, and a lot of the Coca-Cola products are sold through restaurants, so that's hurting them, and their revenue actually took a beating, and it still hasn't recovered. And people are trying to price in the fact that once restaurants get kicking again, this is going to recover, right? This company is actually going to have their revenue pop up to where it used to be. But even now, through this damaged earnings, all right, the dividend is still 3.27%, and they're not even over 100% payout ratio. It's 75%. So they're able to comfortably cover their 3.27% dividend with current revenue, right? And I think that's just incredible. I mean, you know, even over here, I don't see any red in their margins or anything like that. Like, this company is very steady, and I think that it's probably a buy, right? This company is also a buy. Let's take a look at one that I found that's not doing that well, which is Salesforce. Definitely want to fade Salesforce. Not a fan of Salesforce, even though it won like Company of the Year or something like that, like a few years in a row or something. I don't know. But a lot of people are praising this company, but just a snapshot of the numbers here, it doesn't look very attractive to me from a like classical, you know, standard valuation viewpoint. Not that I'm a big time analyst or anything like that, but you know, it doesn't pay a dividend. You know, it's a growth stock. So I guess it's judged by different standards, but I mean, I personally wouldn't buy this. Anyway, that's one that's like iffy, you know, I'd fade it. McDonald's not doing as well as it should, I guess. P is very high. Margins are always good on McDonald's, and the dividend is 2.42%. Payout ratio 77%. I wouldn't buy this. This to me is a bit overvalued, but I'm not looking at the chart, right? I'm just by the numbers. So I guess I'm not a huge fan of McDonald's right now. J&J, Johnson & Johnson, it looks like a pickup to me. Alright, so 2.44% dividend here. Payout ratio is only at 66.9. Margins are always good. It's the P is pretty high, but forward P is about 16. So I mean, maybe I won't buy it personally, but it looks healthier than a few of the other companies in the Dow Jones there. So it's probably pretty fairly priced, actually, if I were to guess, just judging by these numbers here. Alright, Home Depot. Home Depot is not doing very well, right? Everybody's staying at home. So it took, I guess, its earnings fell quite a bit because it's at 24, forward is 22 PE, and dividend is 2.14. Payout ratio is only 50%. So not doing too well, but I would say this company, based on what I'm looking at here, is fairly priced. So fairly priced company. Honeywell, this one, you know, in this more in the industrial camp here. It looks okay. I mean, considering the fact, you know, of course, that the industrial sector has been hit very hard. This P is high because of the earnings hit, but I think that their forward PE is even a little bit underestimated here. If things start to recover quickly for them, you know, their margins look good, and payout ratio is only 42.8% on a 1.84% dividend. So that's comforting. They don't have a huge amount of employees, only 113,000 on a 140 billion market cap company. So I like that. You know, that indicator for me is okay. Now we're gonna go into some techies. Here's this is Cisco, a very legacy, you know, internet technology company here, back from the 90s. And it looks pretty solid. I mean, I can't say that it's a growth, right? It's not gonna grow really, but if you're just looking for a steady company to just bring in some cash, their margins look great. Their PE right now is 19, but forward is 13.59, so definitely not overvalued. Cisco is a good pickup right now. Only 77,000 employees on a $196 billion company. Not a hater of that. Right, payout ratio is 53%. Very comfortably making its payments to its investors. The company is pretty solid. I mean, I wouldn't mind owning it here. And then the biggest steal of them all, right? I mean, is Verizon. I was very surprised. I'm popping up on the chart here because I want you to look at this first. All right, so I learned, I heard in the news or read an article that Warren Buffett's has shown that he picked up some Verizon, and I'm like, oh my gosh, I was looking at the Verizon just, a couple of months back when I was comparing it to like AT&T and all that, and I said Verizon is a better pickup, probably one of the best telecom companies, to pick up right now, and I didn't do it because it was like 60 or something, but I didn't realize that it dropped into down to 54. And at 54, that thing is an absolute steal. I mean, look at the numbers in this company. It's insane how undervalued this company is right now. Look at this. All right. Let's start with the PE here. Look, it's 13 price to earnings ratio right now. Forward P is at 11. Okay, that's huge. I mean, that is super undervalued considering the fact that I think Verizon is going to be growing even more. The margins are great, and it pays a, get this, you can't see it on the screen. Oh yeah, you can on the left side. 4.4% dividend. Can you believe that? 4.4. And its payout ratio is only 52.9%. So you could double it and sustain that dividend if you wanted to. I mean, I've never seen anything like it. I think that the only thing that comes close to these kinds of sustained dividends are energy companies, and that's it. It's the only way you can get this kind of dividend yield. I mean, it's amazing. It's amazing. I can't believe it. So this is an absolute steal here. I can't believe how undervalued. So actually, that's why I picked up a few, 10 shares to be exact, Verizon, because I just couldn't not pick them up. I mean, if I get a chance, whenever my cash frees up next week, I might start selling very heavily puts on Verizon and see if I can collect some premium off there and see if Verizon drops down enough so I can own it. But that was just very impressive to me, and I can't say how much of a buy it is. By the way, even though I'm raving about this company right now, none of this is financial advice. Of course, you got to do your own research and due diligence. Just because some idiot on YouTube, well, I'm not an idiot, but some random person on YouTube says to buy his company or that they're going to buy his company doesn't mean that you should buy it or it's suitable for you. So make sure that if you don't understand anything, you consult with a financial advisor, and because you could lose everything in the markets, including total loss of principal if you do things wrong. All right, so that's the last company I wanted to look at, and I mean, the impression that I got from the Dow is that there's a few dying companies. There are a bunch of fairly valued companies, and like 4 or 5 just absolute steals. So, based on my opinion, I don't think the markets are overvalued at this point. And I think they can probably get a little bit extended before we have the next correction/crash. And this correction/crash is not going to be very long-lived unless there are enormous problems with the way humans live their life, like a pandemic, right? If things get really worse and it doesn't look like life will be going anything close to what we're used to, what we call normal, right? So unless there's a global catastrophe, another one, that dip, no matter how big it is going to be swiftly bought, and I'm going to be the one that is buying stuff up even at higher prices, because another 30% bear market is going to be, a really big gift at this point based on the numbers that I'm seeing. Like, I don't envision a scenario where the earnings for these companies can crash quickly, especially with all these stimulus that's coming out, and an accommodative Federal Reserve and all the other perks that politicians are promising for the regular folk out there. I just don't see how the earnings can drop, barring some kind of catastrophe. Another one. So there's a dip, buying it. Okay, that's what I'm doing. Doesn't mean that's what you should be doing, but that's what I'll be doing. Okay, I'm a little too excited about this new prospect. Finally found something to sell puts against, other than what I've been doing. I mean, there's a lot of stuff. Look, EPD's great for me to start to continue to sell puts against. Like, I still want to get into realty income. Like, there's a lot of options out there, and people that are saying that the markets is priced, it's very rich right now, it's priced high and it's overpriced, that I just don't think they're looking at individual names. But if you want to look at the entire sector, I'm sorry, the entire index as a whole, maybe you can make a case for it, especially if you go into the S&P 500 and include companies, or the Nasdaq, like the EV space and the social medias, and like pot stocks, and all these other hype train type of investments, then maybe you can make a case that there's like a mini bubble there. But it feels to me like it's a 3D printer bubble back in whatever year, where it doesn't really affect the overall market. So just because there's kind of a shift going towards EV, and there's just a bunch of money slushing around, doesn't mean that it's going to take the market out whenever there is a correction. And if it does, I think it's going to be a gift. All right, I think I've been babbling too long on this topic. I'm going to leave it right there. Hopefully you'll gain some perspective by looking at these numbers with me. I sure did. And perhaps it will make you have better decisions about what you're going to do with your own money. All right, that's it. Peace out.